This is the Grants Interest Rate Observer podcast, coming to you from the Grants Interest Rate Observer radio transmission tower at our corporate headquarters at 2 Wall Street. It's a pleasure to have you with us. We are sponsored today by bonwe.com, the famous travel site, and we are sponsored by Pitney Bowes SendPro. So thank you, Pitney Bowes, and thank you, Bonwe. Around the table today are my friends, the great Evan Lorenz, the deputy editor of Grants, Eric Whitehead at the controls, and Phil Grant, the author of our daily splendid emission called Almost Daily Grants. It's free, and you got to read it. And I would first like to call to our listeners' attention the new filing of the Swiss National Bank. That's the gnomes' own Federal Reserve, so to speak. It's their central bank. And what the Swiss National Bank does is to create francs, and it creates them for the purpose of suppressing the unwanted appreciation of the national currency. Now, exports, Evan, as you know, because you told me, are a major portion of the Swiss GDP. And it will not do for the Swiss to be unwontedly strong, the Swissy to be unwontedly strong. It has been, not in recent days to be sure, but it has been over the course of years and decades. Been a kind of a port in a storm. So there's trouble in the world, people flock to the Swissy, even when North Korea is rattling nukes. In fact, Evan, people were flocking to yen too. Japan being slightly closer to North Korea than Switzerland. Go figure that one.
Yeah, one can kind of understand why people go to the Swiss franc when there might be a nuclear war between the U.S. and South Korea or North Korea, but Japan's kind of in the firing range.
Yeah. Well, maybe they'll seek shelter in the South Korean won, too. But anyway, we're talking about the Swiss franc. So the Swiss National Bank is not just a central bank, Evan. It is also one of the players in the world of equities. It buys foreign currencies with the francs it creates, and with the dollars, it buys bonds and cash instruments, and it most notably buys equities. It has $84.3 billion worth of stocks, which a lot of money, even if you say it fast, $84.3 billion. And it buys these stocks without much, indeed, without any analysis. It buys them by what, market cap weight?
It just seems to buy the broad market.
It buys the indices like everybody else. So it owns 1,481,000 shares of Amazon or something. It owns 19 million shares of Apple. It owns 8.8 million shares of Facebook. Netflix, 1.5 million. I mean, it buys them because it creates the francs with which it buys the dollars, with which it buys the stocks. Evan, what exactly is real about this?
Well, I mean, the businesses it's buying are real.
Yeah, well, I guess the stock certificates are real too, and the francs, I guess, are as real as Ethereum, right? Yeah. Okay, so that's our quarterly riff on the Swiss. I must say, Evan, I find the metaphysics of this puzzling. And to me, it is representative of a great deal of what's going on today, which is the preoccupation with central banks and their policies, the single-minded analytical focus, it seems, on those policies.
I also wonder about the physics. I mean, as a major U.S. equity shareholder, it should, as a good steward of capital, actually be voting proxies. It owns thousands of shares. I mean, do they actually have an analytical team going out there looking for good corporate governance?
Well, I think their analytical team is roughly the size of the one at Vanguard that surveys the index funds, I would guess. I think the Swiss have protested against the possibility of the Swiss National Bank buying the likes of Raytheon and other merchants of death, not to recall a phrase from World War I. But I don't think that they're asking, how Netflix is going to be impacted by Disney's decision on doing its own bespoke distribution of content.
And they also own Valiant, which is a corporate maldoer who's actually hurt a lot of Americans.
Yeah, they own Tesla too. That's another story. Bonwe.com is a proud sponsor. I guess it's proud. Yeah, Bonweed.com is pretty darn proud of Grant's podcast, and we are proud to be sponsored by Bonweed.com. That's BONWI.com. Now, Bonweed.com gets you the best hotel rates and up to 30% back in rewards. It's a travel site where you can book hotels and cars. They scan all major travel sites to bring you the absolute lowest prices. In fact, they guarantee it with up to 110% of a price guarantee. And when you book through bonwe.com, you get up to 30% back in reward points. And other travel sites give you what? 2%? Yeah, thanks. So reward points can be used for airline tickets, hotel stays, gift cards, what have you, maybe even gift baskets. And these points have no restrictions, no blackouts, no processing fees. So learn more by visiting bonwe.com. Again, that's BONWI.com to start saving money on hotels and getting up to 30% back in rewards. Thank you, bonwe.com. Corporate bonds are the rage, right? You have to own bonds. Because why? Because, people need income, right? And income is hard to get, and Treasury securities yield nothing or next to it still, although Treasury bills yield even in excess of 1 whole percentage point. It's a change. But infamously, fixed income securities offer precious little income, so people, take what is available, not what they wish was available, and they are buying corporate bonds. A lot, right?
Yeah. Well, according to SMR Money Manager Survey Asset Allocation, which is a survey that dates back to 1999, corporate bond allocations are the biggest in client portfolios on record. I mean, people are owning more corporate bonds than they have since at least the height of the dot-com era.
Yeah, well, they buy corporate bonds because they yield an increment more than government securities. And, among the issuers of corporate debt, certainly the most publicized recent issue, or prospective issuer, we should say, of corporate debt is Elon Musk's own Tesla. Tesla is out there selling. Phil, you've been following this. How much are they selling? Are they
a $1.5 billion issue that they've been raising this week. An interesting story from Bloomberg yesterday, updating us on the progress of the roadshow. An investor, unnamed, I should say, told Bloomberg that Elon and his charm offensive, that's their words, managed to raise no less than $600 million on Monday after just a few hours of a presentation in Manhattan. Not too shabby for one day's work, I would say.
Especially when adjusted for free cash flow or the lack of it, no?
Yeah, I think they burned something like $1.4 billion in free cash flow in the last quarter. And that meeting, I think it was in the Palace Hotel, not a shabby place.
Yeah, well...
There's also a funny quote from Marty Fridson in the story, noting that it's a great deal for them, which by definition means it can't be a great deal for the investors. So I suppose we can count him as not among the capital committees.
I would guess not. But Tesla is many things, but Evan, it's not in the restaurant business. Which business is on fire, no?
Yeah, well, at least hiring in restaurants is on fire. The Atlantic had an article out today noting that growth in restaurant jobs has outpaced overall job growth for the last 7 years. And in fact, if you look in the last 200 days, basically Trump's presidency, restaurant jobs have grown faster than any other category in the country. More and more of us are serving food to others who are buying food, and that seems to be the business.
It's in a way, it's like podcasts, because everyone now, right, has a podcast. Well, just fine, it's about everybody. And if we all listen to each other's podcasts and monetize them, as we at Grants are attempting to do in our way, I can see this as being a big, big contributor to GDP growth.
There's one up for a podcast. The New York Times says a lot of people listen to them at 4 times speed, so you can get through 4 times the number of them. You can't fast forward through a restaurant meal.
Oh, no? It's spoken like somebody who's not yet a father. But please proceed. Tell us about the significance of this massive hiring at restaurants.
Well, the interesting thing is there's been a very, very, very long-term trend towards people eating outside of their homes. In 1950s, roughly a quarter of a consumer's budget spent on food was spent on food outside the home. Today, it's around 50%. So like half of all the money that we spend on food, we spend at McDonald's or Per Se or whatever restaurants you go to. And in fact, people kind of expect this to continue. So the chief strategy officer of Starbucks was asked about this. I mean, there's been weakness in recent restaurant same-store sales, and people are saying, well, what does this mean? Are consumers changing? And here's what he said. Let me first frame this with a little bit of long-term view here, which is that the U.S. and just about any other market we've studied, there's a decades-long trend for growth away from home, food and beverage consumption, driven by demographics, and people just want more convenience. And we're strongly bullish on the long-term continuation of that trend. But the thing is, there's a limit to how much of a budget of the consumer, like eating out of home, can capture. It can't get more than 100%. We're already 50%. There has to be some kind of limit. And restaurants keep on building more and more, or restaurateurs keep on building more and more restaurants. One, because capital's cheap to do it, but also because they saw this long-term trend that they just project ad infinitum to the future, and they think they can keep growing, to the sky.
Yeah. We are brought to you in part by SendPro. SendPro from Pitney Bowes. Now, did you know that compared to Stamps.com, SendPro has 3 times the features at 1/3 the price? Well, it's true. You can print stamps at your computer, call it the Internet of Stamps, if you like. Or you could wait in line at the post office, up to you. But you don't have to. No special equipment is required for the SendPro. You can print paid shipping labels for U.S. Postal Service, UPS, and more. And you can track your shipments from the same easy-to-use interface. You can save money, too. Pitney Bowes has negotiated special rates for SendPro users, with savings starting at 3 cents per stamp. Want to learn more? Of course you do. Visit PB, as in Pitney Bowes, pb.com/grantspod to find out about an introductory offer that features 90 free days of SendPro, along with what the Pitney Bowes people insist on describing as a free 10-pound scale, when in fact the scale weighs substantially less than 10 pounds. I suppose they mean it weighs up to 10 pounds. Yes, that's what they do imply. So thank you, Pitney Bowes. Well, we at Grants are in favor of long-term trends, especially the ones that, especially the ones we approve of, I guess I was trying to say. But we don't approve of all of them, Evan. In fact, I wish to, by way, this is kind of a self-advertisement here, but it's in the service of illustrating that long-term trends don't always endure for the long term. That is, putative long-term trends are not always for the ages. And in the work we did leading up to the issue of Grants, we just published, today, wait a second, this is coming to you, ladies and gentlemen. I got to admit, it's coming to you not on Monday when it's released to the world, but rather the preceding Wednesday to accommodate vacation schedules, of which more in a moment. But we are talking to you shortly before 5 p.m. Eastern Time on Wednesday, August 9th. This is the day that we release Grant's Interest Rate Observer of the World, and you can hear the hubbub out there in the street, Evan. This is it must have hit. But in preparation for this issue, we hark back to something we wrote in 1996, October of 1996. This is apropos, ladies and gentlemen, of long-term trends and their longevity. And at the time, the great CEO, the Lord of Creation CEO of that era, was Roberto Goizueta, who was the chairman and CEO of Coca-Cola Company. Now, Mr. Goizueta was one confident CEO. And here is what he said in 1996, in the fall of 1996. He said, he referred to, quote, our virtually infinite opportunity for growth. Now, that italic, infinite, was his, not mine. And Coke, indeed, at that era was deploying an infinity symbol as they put it, an unregistered trademark of our growth potential. Now, Evan and Phil and Eric, when you tempt the gods like this, you are just asking for like a big cream pie in the face, are you not? You can't do that. You can't say infinite and italicize it and mobilize an infinity symbol in your advertising. It's not good. So in the 1995 annual, here is what Coca-Cola management asked itself rhetorically in the opening letter. It said, is there ever a time you wouldn't consider buying your own stock? This is the Q&A in the 95 annual, excuse me, it was a Q&A. Yes, management answered its own question. Whenever securities laws say we can't. Otherwise, we've yet to encounter a time when we felt our stock wasn't a good long-term investment bargain for us. I mean, many people thought the same because this stock just went straight up. It had been going up since, I guess, since Mr. Goizeta came on as CEO about 1982. And New Coke fizzled a couple of years later, didn't matter. But Diet Coke was certainly a hit. Anyway, the stock just was going straight up. So markets make opinions, as I've quoted my late great friend Richard Russell from time to time. Markets make opinions, and the market was so dead sure that Coca-Cola was for the ages, and it might be, but its growth track was certainly not. It came to this that Mr. Goizeta analyzed Coke's progress or potential progress by observing that human beings consume, we said 64 ounces of liquid a day. Yet Coca-Cola currently provided fewer than 2 of those ounces. Well, 64 minus 2 is what?
It's a serious growth runway.
Yeah, serious growth. To answer my own question, that's 62 ounces. Yeah. And anyway, so the Coke's then share of the worldwide soft drink market was 47%, which is not unlike the share of restaurant, what am I trying to say? Share of people's
Wallet?
stomach. Stomach, yeah, it's a little vivid, isn't it? For this, yeah. But 50% is the percentage of the food budget spent on restaurants. No, okay. Yeah. So in Coke, 1996, it was 47%, and I'm not sure where they are now, but they have not achieved 101%, nor have they reached the 64-ounce lit of human liquid consumption. Oh, I suppose that could have bumped that up with some clever advertising. But anyway, so 2 things that a conscientious journalist might observe about this story in Grants of October 11th, 1996. First is that it was a heck of a call. I must say it was a heck of a call. Because presently, I'll come back to this, presently, Coca-Cola shares peaked and spent 14 years in the growth stock wilderness. 14.
16.
16, yes. Okay, that's the good part. The slightly unmentionable part, but nonetheless, to be mentioned right now, is that this stock did not go down because we observed the absurdity of the infinity symbol in the advertising logo. Nor did it go down because we called upon the market gods to mobilize their thunderbolts against the presumption and the hubris of Roberto C. Goizeta. It kept going up. Yeah. So that's life in the growth stock lane. But, it doesn't hurt to at least stand back from time to time and look at a putative, long-term, indeed, a putatively infinitude of tangled words, to stand back and take the measure of claims that on their face are implausible and just to say, thank you, not I. I will not participate in this particular excess, which is where we at Grants now stand with respect to stocks, bonds, commercial real estate. What else?
Just
a lot we don't like, isn't it? Yeah, okay. So.
It does seem like bond investors don't share our opinion. On August 8th, Restaurant Brands International, which is a Grants bet noir, was able to sell in an upsized deal second lien notes that yielded 5% and come due in 2025, and an upsized deal to $1.3 billion from initial parameters of $1 billion. These notes yield only 75 basis points more than the first lien notes of 2024. So for the single B issuer that has, I think 4.5 times net debt to EBITDA, you only get a 1/4 point of extra yield for basically getting no collateral against your claims.
Yeah. Our friend Marcelo sent this to us. Thank you, Marcelo. Very good citing. And this is indicative of what's going on in the capital markets. People build restaurants in part because they can, because the cost of capital is slightly more than negligible.
Yeah, they build them and buy them. So Carroll Restaurant Group is actually the biggest franchisor of Burger King restaurants, Burger King being one of the brands of Restaurant Brands International. Their sales grew 15.8% year over year in the second quarter, and these results were just out on August 9th. This was largely due to acquisitions. However, their adjusted EBITDA, the ones where they actually take out all the costs they want to recognize, actually fell. They fell to $27.5 million from $27.9 million in the year before. So it's a very unprofitable growth.
Okay. I don't know. You know what the next thing is around here? The next thing around here is vacation. And if I had thought about this more, I would have had ready the great 60s or 50s rock and roll song, Vacition, in the summertime. But not having anticipated, this song is not available. So I will thank our listeners for being with us and say we'll see you on Labor Day. It's been a delight, and we expect to resume operations in, 3 weeks. So thank you one and all. Back to you soon.